quality in collaboration with states and industry over the next 5 years will transform human capital. In addition, the proposal to enable an internship of 1 crore youth with India's top companies in the next 5 years can be transformative. To enhance the ease of doing business, measures were announced to set up an integrated technology platform for enhancing outcomes under insolvency and bankruptcy code, processing accelerated corporate exit for LLPs, and strengthening and proliferating debt recovery tribunals. Reforms proposed in the areas of land administration, urban planning, usage and building bylaws in rural and urban areas will be a game changer. In addition to the land registry proposed for rural areas, all land in such areas shall be assigned a unique land parcel identification number. Simplification of the Income Tax Act 1961 for consciousness and ease of comprehension, for conciseness and ease of comprehension, facilitated measures in terms of reassessment and search cases are welcome moves. The announcement to incentivize states for implementing Business Reforms Action Plan and digitalization under the Jan Vishwas Bill 2.0 will significantly contribute to enhancing ease of doing business across India. The budget retained capex outlay on infrastructure at rupees 11.11 lakh crore as announced in the interim budget, which is 3.4% of GDP, almost double the level seen in 2019-20. Thrust on urban development and positioning cities as growth hubs will support economic growth. Special focus on redevelopment of existing cities, transit-oriented development plan, water supply, sewage treatment, and solid waste management projects and services will position the cities as growth centers. In addition, the extension of Pradhan Mantri Awas Yojana Urban, which will cover 1 crore poor and middle-class families, is welcome. To facilitate higher participation of women in the workforce, measures were announced to set up working women hostels in collaboration with industry, pressures introducing women-specific skilling programs, and promoting market access for women SSG enterprises. We are happy to note that one of the key recommendations of CII, which is employment-linked incentive, was included in the budget announcement. This will aid the generation of quality employment opportunities for the burgeoning youth population. The abolition of angel tax across investor classes has been a long-standing wish, and it will boost the Indian startup ecosystem and promote innovation. The measures aimed at proposing a comprehensive rationalization of GST tax structure and review of customs duty rate structure across items will improve tax base and support domestic manufacturing. Announcements were made to enable more disposable income in the hands of taxpayers who have migrated to the new tax regime, and simplification and rationalization of capital gains. Friends, this budget seems to be a foundation stone laying for the Amrit Kal period with a thrust on Sabka Saath, Sabka Vikas or Sabka Vishwas. I hope that today's session will delve into the details of these and more, and I look forward to the deliberations. Thank you.
Thank you, sir. I would now like to invite Mr. Naveen Balodia, Partner, Tax and Regulatory Services, BDO India LLP, to deliver his address.
Thank you, Ricky, and good morning to all of you. And welcome to this session on budget. As we look at the budget, the Prime Minister, the Finance Minister actually was presenting her 7th consecutive budget this year, which is actually a record. And there was a lot of expectations post the election. So that's what was expected by the entire industry and the economy. Of course, the economic survey gave a few positive indications, be it in relation to inflation or the fiscal deficit or the GDP. There were some positives that were coming out. What we looked at when we looked at the budget proposals and the announcements made, what we found was that the finance minister has touched upon all the major key issues that were being discussed in the industry, in the economy, and in the political circle as well. So I think that's the type of involvement. At least they have at least listened to all those pointers before coming on to the budget table. If we were to just look at the overall announcement, we can actually club it into, say, five broad themes where the finance minister has focused upon. The first one is, of course, skilling and employment generation. I think this is something which was being discussed, was an issue even in the last elections. And to that extent, the government has come up with five specific, like, incentive schemes for employment generation. And that's something which is going to be relevant as we move forward, addressing the skilling as well as the employment related issues. You know, the government actually has gone ahead and allowed a part of the CSR fund also to be used for some of these schemes. So that's the way they are thinking overall. The second thing is that it is expected, based on the advent for in artificial intelligence, that India's software and service industry actually, the growth of it actually can taper down in the near future. So to supplement that, tourism is something which is being focused upon. When we looked at the budget proposals, one such proposal was on domestic cruise. Now it looks like a very simple sort of a proposal, but definitely it has a potential to generate a lot of employment. And the third important thing was, various kinds of loans, be it skilling loan or be it education loan, when we talk about upgradation of the human power or the manpower that we have in India. So I think these are some of the elements with respect to skilling and employment generation. The second theme that we recognize was impetus on foreign investments. When we talk about the tax rates being brought down for foreign companies from 40% to 35%, there's a logic behind it, because the corporate tax rate for Indian companies were brought down to 25% a couple of years back. So to that extent, in order to align it with the Indian corporate so that the difference is not too much, they brought in with this reduction. Definitely a welcome move. There is a commitment to actually relook and simplify the FDI regulations as well as the ODI regulations, again something to support foreign investments. Equalization levy 2.0, that was relevant for e-commerce operators, that has been taken away, again something which is very, very relevant. And angel tax, when you talk about investments coming into India, specifically into the startup ecosystem, that was definitely a concern for the entire industry, and that's something which is taken away. I think again a very, very important move to support the startup ecosystem. And then there are elements which support, like, expansion of the safe harbor rules and things like that. So those are all looking at and trying to support investment from foreign entities, from foreign jurisdictions into India. So that was the second sort of a theme. The third theme that we identified was an effort to simplify the tax regime and dispute resolution. I think that's something which has been the focus of the government for quite some time, and they have continued with that in this budget as well. I think when we talk about the Income Tax Act of 1961, it has been there for quite some time. There was an effort to revamp it. Now there is a discussion again on a comprehensive review of the income tax law. Definitely something that could be actually, change the way we look at tax as we move forward. Capital gain taxation, yes, there is an increase, but again, there is a focus on simplification of the tax regime rather than trying to complicate it. Yes, there are concerns that, okay, there is a rate increase, but at least the way the stock market would have reacted yesterday and today, looks like they have absorbed or they were expecting this modification. Again, an effort to make reduce dispute in the form of Vivad se Vishwas for all income tax related matters. Although, it looks like it came too early because, the last one was just 4 or 5 years back. So it was not expected, but again, they came up with that, scheme as well. And then also elements on or the modifications on the IBC regulations. Either we are talking about simplification or strengthening the tribunals and the appellate tribunals. So that's the third theme Hello.
Yes, you're audible, sir, now. In
Yeah,
between, you were not.
sorry. Yeah. So there was a requirement, there was an expectation, of course, sustainable energy requirement as well as our growth aspirations, because we are a developing country and we expect to, one of the fastest developing countries as far as the major economies are concerned. So definitely something which has been a focus. What the government has supplemented, apart from the solar or the renewable sector, they have looked at areas like nuclear or biomass, which may not be a renewable energy as such, but at least a clean source of energy to supplement the transition into a sustainable energy ecosystem. uh, when we talk about renewable energy, there is this concern about instability of the entire grid, because it can only supply energy when the sun is there, and otherwise it cannot supply energy. So there is a requirement to work out some sort of a pumped storage sort of a scheme and schedule. So that's something which is being looked into. And of course, recommitment to the green hydrogen project, that's something which is very, very important as far as the fourth theme is concerned. The fifth theme that we looked at was again to continue with impetus on infra and MSME. I think that's something which was very, very important. It has been done by the government in the past as well, although not much has been spoken in the budget speech. But again, there are allocations which talk about these infra impetus. And when we look at the spend on infra, this is something which is very, very important, because a revenue expenditure will actually have a multiplier of say 1 or maybe less than 1. But when there is a capital expenditure, it results in a 2.4 or maybe around 3 sort of a multiplier effect of the overall expenditure. So to that extent, capital expenditure or infra is something which is very, very important. You to see more participation from the private sector, from the private players, companies, as well as people for foreign investors in this particular space. So overall, if we were just to look at the way things are, the proposals are, all the key pointers that were being discussed probably in the last 6 months run up to the elections, and as we move to the next elections to the three large states, have been touched upon. The directionally looks like a positive step. But of course, what was very important is whatever is being talked about being implemented on the ground properly. So I think that's something which is going to be the important thing or a test as far as the budget proposals are concerned. So maybe after this, my colleague Payal and Bhavin will talk about the key direct tax as well as indirect tax proposals. But I think this is the broad thought process that we gathered from the budget 2024. Thank you. Ricky?
Thank you, Mr. Balodia. I would now request Mr. Bagla to deliver the vote of thanks.
Thank you very much, Mr. Balodia, for your overview on the budget. Very exciting to know that the government has come up with a well-rounded budget, and this is what we understand. And implementation and execution is the key, is what we understand from what you said, and that would make the difference. I now invite Mr. Rajendran Arunachalam, convener CI Maharashtra panel on finance and taxation, and Executive Vice President and Group Chief Financial Officer, Thermax Limited, to kindly take over the detailing presentations on the Union Budget 2024 budget impact analysis and take it forward.
Thank you. I hope I'm audible, Ricky.
Yeah. Yes, sir.
Yeah, okay. Thank you. So thank you all. I think a bright day, and I think good budget, I think yesterday, in line with many of the expectations. Of course, some which was expected by the capital market participants did come, and I think though there was initial disappointment, I think the market has reacted well, both on the capital markets, equity markets, and the debt markets, which is a good sign of acceptance of the budget proposals in a positive sense. We are here today to discuss the impact of the tax proposals and the more detailed aspects of the budget. Let me welcome a few people who are going to take us, help us through this thing. One is, of course, Mr. Naveen Balodia. You have heard him speak, partner and leader, North Tax and Regulatory Services of BDO India. We're going to have Miss Payal Thakkar, partner, Indirect Tax, BDO India LLP, and Mr. Bhavin Shah, partner, Corporate Tax, Tax and Regulatory Services, MSKB and Associates LLP Group, BDO Group firm. I think going by the budget proposals in detail last night, what I think I liked as a finance person myself was that the government has become very fiscally prudent in terms of ensuring that all the additional surpluses that they have received in the last year, including the RBI dividend that they received in a big measure last year, they have made it a point to ensure that the fiscal consolidation path that they have chosen remains stable, and a 20 basis point fiscal reduction coming out of that RBI contribution is a very good thing to note. So prudent fiscal management, financial management is being followed by the government, and in the long term this will hold very good for the economy and as a country, where our finances will be looked upon very well among the comparable countries, and we will attract more stronger FDIs, and I think that's definitely a positive for all of us. Talking about a few budget proposals which I think were relevant, that caught my eye. Definitely, I think the capex, it was talked about just now on the multiplier effect, the 11.1 lakh crores of capex that has been continued to be maintained, which was there in the interim budget, and so that's, I think, a positive which continues to be there. There is also definitely a support on MSMEs, which is, I think, coming in 2-3 measures, which I think I'm sure our speakers will cover them in detail. MSMEs are the backbone, and we find that the support that is coming in is good. The reduction in the corporate income tax for the foreign companies are definitely a positive, signaling that the tax rates are also getting rationalized compared to the domestic companies that have been enjoying a lower tax rate. Of course, the other focus of the budget has, of course, been on the jobs and skilling. I think there are quite a few measures. I think there are at least 3 schemes that have been introduced to push for employment in the formal sector. Something like an EDLI, employment-linked incentive schemes, similar to the productivity-linked incentive schemes which we've had in the last 2 years on the capital investments that have been happening. So that's, I think, all of them are positive and will help in employment. Of course, on the skilling side, I think the government is showing its initiatives in setting up, upgrading about 1,000 ITIs, as well as setting up some skilling centers through the various clusters. I think that's good. And then there is also an internship program, the details of which, of course, we will all come to know in more detail. But I think the top 500 companies are going to be part of that initiative, and about 1 crore of youth are expected to be skilled with practical experience in the corporates. I think that would be a welcome measure in skilling people, as I think it was mentioned in the budget yesterday as well, that there is a skilling challenge that people face in employing new people. The GST and the customs duty measures have been more in terms of rationalizing some of the challenges that the corporates have been facing. Lots of them are administrative reliefs, but definitely a welcome measure. On the direct tax side, I think some interesting changes that has happened. Of course, the surprise change, and I think many of us have been talking about, is the indexation benefit that has been removed, and the capital gain tax that has been simplified in terms of stepping it up from 10% to 12.5% in case of assets, non-financial assets. This is a large move, and I think while it simplifies things, it does increase the tax impact for individuals as well as corporates on transactions. The Vivad Se Vishwas scheme 2024 that is proposed to be announced is, I think, definitely a benefit in terms of resolving the older tax disputes, and I think that would be definitely a welcome move. The angel tax for the startups, which had been a point of contention for them, I think has also been removed. The buyback proposals, I think, which has come on the table, I think indicates that the government wants to push dividend as a more as an option that the corporate should choose for distributing its surplus cash. That's, I think, how I am reading the proposal to be. The other sector which I think has found a lot of focus and this thing is the renewable energy sector. I think quite a few proposals, and I think Thermax Limited, which I'm part of, is a corporate which is focused on this renewable energy space, and I find that many of the proposals that have come in that space is really encouraging. There is a pumped storage policy that is proposed to be brought in. There is a policy for energy transition pathway, which is, sometimes there is conflict between balancing growth, employment, and environment sustainability. So I think the government is likely to come out with a policy around that, which is again a positive. There is energy audit support that is going to be provided for MSMEs. MSMEs have been slow in this transition process, and I think there's going to be an enablement around that. Another interesting is the taxonomy for climate finance. This will, definitely help corporates and the financiers find the right definitions of activities which fall under climate change and which can attract the right amount of financing. So that's, I think, a positive move. And I think there have been proposals on nuclear reactors as well as AUSC based thermal power plants which has a higher efficiency. I think things like that as well are coming in, and of course certain customs duty relief on minerals which are focused on the renewable energy space and nuclear energy. I think those are also welcome move. And there are many other proposals which impact many other sectors, but these ones caught my eye specifically because of its impact to my organization. But yes, of course, we have the experts who will take us through all of this in more detail, and I'm sure we are eager to hear from them. So can I request them to now take over and share their views, and we would be very keen to hear them.
Sir, I'd like to invite Mr. Bhavin Shah now, Partner, Tax and Regulatory Services, MSKB and Associates, LLP, to speak about the direct tax amendments.
Thanks, Ricky. Am I audible?
Yes, you are, Bhavin. Please go ahead.
Yeah, I'll just share my screen. I hope my screen is visible.
Yes.
Yeah. So I think warm welcome everyone, and thanks CII for having us to discuss the budget proposals. So typically, whenever if you see the past 4 or 5 years, the trend has been from the date of budget getting announced till the time it gets enacted. Now there are 3 distinct features or 3 distinct activities which keeps. One, there is many proposals and amendments in the bill. That's number 1. Second, after the proposals are being announced, the taxpayers, the consultant, as well as the revenue authorities keep on running to understand what are these proposals all about, what are the implications of these proposals, and what are the loopholes, which of course the consultant would want to find out on that aspect. And the last is, before any budget getting enacted into a finance act, there will be series of amendments which will be brought about it. So I was hoping that these 3 things will not happen, at least for the July budget, but I was being made wrong on this particular aspect. We continue to have series of amendments. I think there are more than 100 plus tax proposals. So as I said, the saga continues, what we have been facing thus now. So I think we have heard from the earlier speakers that, broadly what are the themes that has been laid down in this particular finance bill. So similarly, in the tax aspects also, we can see 5 different themes which are there. First theme is with respect to providing relief to the taxpayer. The second is, I think some speaker mentioned to promote the investments and the employment side of it. So again, we have some proposals around this particular aspect. The third is simplifications and the rationalization of the tax proposals, where you see the TDS and the capital gains amendments. The fourth will be widening of the tax base and deepening of anti-abuse provisions also. And the last is on the tax administration. So I think these were the 5 different themes or basis which all of the proposals have been proposed. So quickly moving on the individual taxation, there are different proposals which have been announced, more to do with or empowering people to select or opt for the new taxation regime. So now for the new taxation regime, instead of standard deduction of 50,000, you have an additional deduction of by 25,000. So the standard deduction now increased to 75,000. Even the tax rate, there has been change in the slab. On an overall basis, the slab remains the same. But if you look at the screen on the left side on the table, the second and the third slab, so which earlier used to be 3 lakh to 6 lakhs, has been increased to 3 lakh to 7 lakhs. Second is 6 to 9, which again has been increased to 7 to 10. But on overall, the slab remains the same. The benefit on account of the standard deduction increase and the change or the tweak in the slab rates has resulted into an overall savings of about 17,500 rupees for an individual. In terms of the NPS, just to ensure or to promote that there are more takers from the NPS perspective, both for employers and for employees contribution, instead of 10%, they have increased the limit to 14%. In terms of the house property, now there have been situations where not just the real estate developers, even the individuals who are owning a house property, the residential house property, they used to offer tax not as a house property income, but they used to offer tax as a business profits. For the variety reasons, because in business profits, you have the loss to be set off, you are eligible for tax depreciations, various other reasons. But now it has been made mandatory that any income from letting out of a residential house property will be treated as a house property income itself. Now, another key proposal, which is not exactly applicable to an individual or HUF, but any corporate gifting, which earlier used to be allowed as, or rather not allowed, there were ambiguity around the provisions, will now not be entertained further. So a corporate entity wishes to give shares to another entity, that will not be treated as a tax neutral transaction. It is only an individual or an HUF which gives the capital asset to any other person. That's where the exemption would prevail. There have been decisions both in favor of the taxpayer and against the taxpayer. So with this, the controversy will put to an end. However, this particular provision is applicable for financial year 24-25. So any transaction involving corporate gifting from 1st of April till date would be subject to tax now. On the business front, I think Mr. Ravindran and earlier speakers have also mentioned that the tax rates for the foreign companies has been reduced from 40% to 35%. So that's a very, very welcome move. In terms of the payments, which is in violation of any particular law, now we have seen there have been disallowances under section 37. In fact, this particular proposals was made very recently in the last 2 budget itself. So there is further clarification which has been provided to say that any payment made towards the settlement of any proceedings under any law, and they will also notify which all laws will be covered in this, will also form part of a payment which is in offense or prohibited by any other law. So that will also be disallowed. This perhaps will be applicable in case of a pharma or the FMCG companies. Moving further on buyback of shares. So yes, we do not have now any tax, or the companies will not be liable to any buyback tax. So earlier we used to have a buyback tax where a company used to pay buyback tax at the rate of 20%. And as far as the shareholder is concerned, the entire amount is not liable to tax further. Whereas now we are going back to a regime where the shareholders will be brought to tax. And there are two different levels. One, the tax would be treated as a dividend. The income will be treated as a dividend. So you pay the tax as per the normal rate of tax itself. However, if you have the existing cost of that particular share which ceases to exist, can be treated as a capital loss. So just to give you a hypothetical example for both in both the regime, how things would unfold. So previously, let's say if you are owning 10 shares of any company, and the investment value of those shares when you are acquired, let's say it's 100. So for you, the cost is 1,000. Now, during the course of buyback, the company is buying back shares at, let's say, 1,000 rupee per share. So you end up receiving 10,000 rupees. So buyback tax was the differential 10,000 minus 1,000, which is 9,000. And on that, you pay 20%, which is 1,800, which the company used to pay. Let me correct that. Now, in the same situation, the dividend income of this, the 1,000 rupees what you receive will be taxed as a dividend income in the hands of the shareholder itself, and it will be taxed at a maximum rate, which perhaps would be 30% also in some cases. And the loss or the potential capital cost of acquisition of those shares, which is 1,000, will be allowed as a capital loss, and then you can set it off against either the current year capital gain that you have, or maybe for the subsequent year. So this is how the things will unfold when it comes to the buyback of shares, which happens after October 2024. Now, the next ask perhaps from the startup community was to abolish the angel tax altogether. And the finance minister has been kind enough to consider this particular provisions. And therefore, from April of 2024 onwards, the angel tax, which is 5627B, has been abolished altogether. Now, if you look at, there have been several measures which has been provided to track the investments made by the investor. So we have Section 68 under the Act. You also have now for the unlisted security, a compulsion to make those shares into a demat format. You also need to report unlisted shares in the income tax return. So to a certain extent, the whereabouts of the investor who is investing, the source of investments, can be explored or examined through using other mechanisms which are there under the Income Tax Act, as well as under the other provisions of the other law as well. So therefore, necessarily it was, it was required that, this particular provisions get abolished, and this is what has happened. Interesting to find out that what will happen with respect to the past cases which is tied up into the litigation. The second, the next moving is on the equalization levy. Now, this was a temporary measure, any which was been introduced from the perspective of e-commerce taxation, or from the perspective of online sale of goods and services. Now, considering that we have been looking into news that sooner or later through Pillar 2, there will be some consensus, and it will see a day at the end of the tunnel. So therefore, it is important to give a clear message to the world, and hence it has been decided that equalization levy should be done away with. Interesting to see is if because the equalization levy is been done away with, going forward, all the provisions of the Income Tax Act as well as the normal tax treaty provisions would be made applicable. So the taxpayer will have to decide whether under the act or under the existing tax treaty provisions, which perhaps could be more beneficial, whether they are liable to tax or not with respect to e-commerce of supply and services. On the capital gains front, I think there are four major areas. The first is areas from the rationalization standpoint. So the first area is to different types of assets having different periods to treat them or qualify as a short term or a long term. So now we have only two class of assets. First is with respect to a listed securities where it is 12 month, and all other securities, all other immovable or movable assets, it has been reduced to 24 months. So no need to go into different categories. We just have two different categories. The second is what earlier we have seen that indexation benefit has been withdrawn. Now this may have an impact with respect to any immovable property or any shares which has been acquired, let's say 10 years or 20 years back. Because of the indexation, the CII, the cost of inflation, could increase the value of the cost at least 3.5 times or maybe more than that. So this will certainly will have an impact, at least for assets which have been held for a longer tenure. Then on the capital gains rates, again, earlier we used to have different rates. Now we have just simple two rates. So all your long-term capital assets will be taxed at 12.5%. Now, immediately after this particular announcement, the market sheds quite a bit of points, and of course they were able to recoup this. As well as on the as far as this short-term capital gains are concerned, again the rate has increased from 15 to 20%. This is in respect to the STT paid gain itself. All the other gains which are short term will be taxed as per normal rate, which is 30% or as per the applicable rate itself. Another aspect that they have covered is extending the exemption when it comes to the capital gains with respect to sale of listed securities. So earlier the capital gains with respect to sale of listed securities were not to be taxed so long as the gain is 1 lakh rupee or less. Now that particular limit has increased to 1,25,000. On the offshore, with respect to the offer for sale, now typically in the IPO, the promoter will be offering their shares, which is an unlisted shares, and in return they would be receiving either a listed shares of that company once the company has been put on the listing side. So there was an ambiguity with respect to the computational mechanism, because we were not able to derive a particular cost because of the lacuna under the Income Tax Act, which didn't provide what will be the cost in this typical situation. Now that lacuna has been plugged to say that the original cost, you will get a step up of the indexation from that particular date till January of 2018, and basis which you will be able to determine what is the cost, and therefore you can now do a computation and derive what is the taxable gain around this. Now, this is the only section which has been made applicable from 1st of April 2017. So it's applicable from financial year 17-18 onwards. Rest, none of the sections are being made retrospectively. This is the only section which has been made retrospectively. On the assessments and the litigation side of it, we are soon going to see a new reassessment scheme. So let me take you a step back. So before 21 of April, we had an old reassessment scheme, which used to be for 3 years, 0 to 3 years, and 0 to 4 years and 4 to 6 years. And of course, then we migrated into a new assessment scheme where instead of 0 to 4 and 4 to 6, we have 0 to 3 and 3 to 10 years. There were certain procedural changes also which was being made in this new scheme. So we have 148A as a precursor to the 148 proceedings and various other procedures being laid down in terms of who has to do what. Now, with a span of less than 4 years, we again see a change in terms of the entire reassessment proceedings. So the new proposed change is instead of 0 to 3, 0 through 3 remains the same, but 3 to 10 will now be reduced to 3 to 5. So that's the bigger change that has happened. So on the indemnifications, typically now earlier because of this increase, whenever a company used to ask for a tax indemnification, they had to give an indemnification for the larger period of 10 years. Now that indemnification would be reduced to 5 years itself. Another change apart from this procedural aspects, which I would not want to bother you too much, the key change is on the specified authority who has been allowed to give the permission or the approval for the reassessment. Now, there have been plethora of decisions to say that, who has to be the specified authority. Is PCCIT has to be the person or is going to be a CIT? Now they have reduced the bar to say that even an additional commissioner or an additional director or a joint commissioner also is allowed to give approvals for the purpose of 148. On the Vivad Se Vishwas scheme, so Naveen did mention that this particular VSV scheme was there even in 2019, 2020, and this is again a new scheme which has been proposed. So more or less the look and feel what we have been able to gather thus far now. Of course, there are certain rules to be notified and certain areas of concern has to be expressly dealt with, which I hope it will be done very shortly. But more or less, the VSV 2020 and VSV 2024, it's more or less the same. Perhaps one can say that it's an old wine in new bottle itself. But broadly, if you look at on the table, I'll just quickly walk you through. So it talks about whether your dispute was existing on a specified date or not. And the new specified date that we have is July 2024. Okay. So if you have, let's say, any dispute and also they have also prescribed one more date, which is December, which is January of 2020. So let's say if a particular dispute was existing as on 31st of January 2020, okay, and it continues to be there as on July 2024, and that particular dispute you want to settle this, then the tax rate would be applicable is, for settlement would be 110% of your disputed tax. As against that, if a particular dispute which was not there in January 2020, but it arose after that and before July 2024, then the amount of tax that you need to pay is 100% of the disputed tax itself. So in a way, this particular provision or the new VSV scheme, it marginally, I would say, provide an additional tax burden on the taxpayer who failed to opt for VSV scheme in 2020. And now they would want to continue for a VSV scheme in 2024. So if you happen to have a change in mind and you have not opted in 2020, but you now want to go for 2024, then instead of paying 100% of the disputed tax, you will end up paying 110% of the disputed tax. Similarly, even if you look at with respect to interest or penalty, instead of paying 30%, you will end up paying instead of paying 25%, you will end up paying 30%. And of course, there is another slab which has been provided that so long as you make the declarations before 31st of December, this 110% would be applicable. But the moment you miss this particular deadline and let's say you do it in the next calendar year, then the tax rate would increase by 10%. So this is the broad, I would say, the areas from a VSV standpoint. Of course, there are a lot many things in the VSV, but most of them, what we understand is similar to what was there in 2020 itself. On the withholding front, especially on the TDS side, towards the rationalization, so we see many sections which were entailing 5% of the tax rate now reduces to 2% of the tax. Also, with respect to e-commerce operator, which we see that as far as Section 194O is concerned, the tax rate was 1%, which has been brought in line with 0.1% TDS when it comes to sale of goods, which is there in 194Q. So both sale of goods as well as with respect to the e-commerce operator, the tax rate going forward will be 0.1% itself. There is a new tax TDS rate which has been provided under 194T with respect to a partnership firm paying any salary, bonus, remuneration, interest, or commission to its working partner. So earlier there was no such mechanism to withhold tax. Now they say that any such payments would be subject to tax at 10%, so long as the payment in aggregate exceeds 20,000. Then we have a situation where an individual is supposed to withhold a tax at the rate of 1%, so long as the value of the property is exceeding 50 lakhs. But there have been cases where instead of one particular seller, we have a co-seller, two seller, three sellers, and each of the seller used to make a payment contribution to less than 50 lakhs. So there have been rulings, and people have taken the benefit of this particular provisions to say that so long as for each of the seller or each of the buyer the amount is less than 50 lakhs, they did not have to undertake this withholding. They are not governed by this withholding provisions. Now it has been clarified that regardless of individual payers or the receiver, so long as the aggregate amount exceeds or the value of the property exceeds 50 lakh rupees, in that situation, the TDS would then be made applicable. Another interesting and welcoming provision is in the respect to 194Q. Now, this is with respect to, or rather, it's not in 194Q, it's only 197, but it pertains to 194Q. This is more with respect to the fact that any person who sells the goods is required to or receive the consideration towards sale of goods would be subject to TDS. Now, this particular provision was not eligible for 197, which is a lower tax withholding certificate, where a buyer can produce this certificate to say that instead of deducting at 1%, instead of deducting at 0.1%, you please deduct at a lower rate, considering either the losses are there or there is not much of a taxable income. So earlier this mechanism was not available, but now going forward, even on sale of goods, you can reach the tax authority and ask for the lower tax withholding certificate. And based on the rate which has been determined by the tax officer, the withholding should be made thereafter. On the TCS front, we have one big announcement with respect to the fact that apart from the car payments, I mean motor car, which has more than 10 lakh rupee value, that should be subject to 1% tax. This was the existing provision that we have. Now, this provision will be expanded rather to cover not just the car, but even any other luxury goods also. They have not yet notified, but any luxury goods henceforth would be subject to 1% TCS. After the introduction of liberalization, or rather the TCS on the overseas remittances, we see that there has been disparity because the payment would have been made by the minor or on behalf of the minor, whereas the TCS actually credit has to be given to the major who files the return. Okay, so this is where there was an ambiguity, and now going forward, it has been clarified that even if the TCS is being deducted on account of minor, the credit a major person can avail so long as the income has been duly offered to tax. So this is again a welcome move. In terms of the other provisions, as far as the withholding is concerned, so we used to see, tax authority sending prosecution notices. Any cases where there was a delay or default in payment of taxes. Now they have clarified to say that, look, we will not initiate any prosecution proceedings so long as you make the payment of that particular tax within the due date of filing the quarterly tax return statement itself. I think if it would have been better had they extended this particular provisions to say that, so long as the tax is paid within the given financial year, but nonetheless, still it's a welcoming move. Even on the compounding side of it, we have heard that the finance ministry will soon be issuing new guidelines for the compounding side as well. Another area more on the procedural aspects is if there is a failure to deduct tax, or if there is a non-deduction of tax, and you often see a notice being served, or at times you have to revise your return or you do the corrections of the return. So there was no time limit which has been prescribed. Now they have specifically mentioned or laid down the time limit to say that it will be 6 years from the end of the financial year. So henceforth, any notice cannot be issued if this six years time limit has been lapsed. On the transfer pricing and other amendments, so quickly, as far as the transfer pricing side is concerned, not much has been there. But the TPO has been empowered to look into the SDT transactions, even though it has not been referred by the TPO. So that's one more, I would say, mechanism basis which the TPO can examine the transactions within two group companies in India itself. And also, just to rationalize things, they are going to come up with the new provisions from the transfer pricing assessment standpoint, as well as try to tweak the safe harbor rules as well. As far as the assessment related matters are concerned, so we have two provisions. So when it comes to, let's say a person, there is a delay in filing return, the immediate step is to approach a CBDT and get the condonation. Now, in that situation, what will be the time limit to close the assessment? Also, in case of a first appellate authority, if they passes an order or to de novo a particular proceeding, or start an assessment all afresh, then what will be the time limit for that? Now the act categorically provides that it will be 12 months from the end of the financial year within which these assessments needs to be closed. Also, one welcome move with respect to the appellate tribunal proceeding is earlier it was 60 days within which a person has to file an appeal before the tribunal in case he or she is aggrieved by the CIT order. Now you have new provisions to say that it will be 2 months from the end of the relevant month in which you have received this order. So going forward, at least 60 days would be available for taxpayer as well as to the revenue authorities to file a appeal before the tribunal. And the last provisions which deals with the foreign assets. Now, this has been a very, very peculiar situation where typically an Indian company employee which would receive an ESOP of the foreign company, the Indian company employee may not have disclosed these assets in its tax return, and straight away they used to get a penalty notice of at least 10 lakh rupees. Now, just to ensure that this particular provisions is being addressed appropriately, so it has been provided that so long as the value of the assets is less than 20 lakh rupees, then there will not be any such penalty being imposed, despite the fact that the individual has not reported in the tax return. So with this, I would like to just conclude to say that if you look at the economic advisor's comment, which came on Monday evening, it says that the tax, the government has to now look into the nuts and bolts of the governance rather than coming out with the new policies altogether. So here we see that there are many provisions which deals with all the nuts and bolts, tightening of those nuts and bolts around it. And with this, I think the next in store is what we have heard from the earlier speaker is the new direct tax code, which is going to be there. So again, as the finance minister has mentioned that in the span of 6 months, you are going to see a new direct tax code. So many things has been in store for us in the future as well. So with this, I would like to conclude.
Thank you, Mr. Shah. Requesting participants to post their questions on the chat in the chat box so that any queries you have will be addressed by the speakers at the end. I now invite Ms. Payal Thakkar, partner Indirect Tax, BDO India LLP, to present.
Thanks, Vicky. Good morning, everyone. We are still at 11:30, so it's not noon. So Bhavin, thanks. Like Bhavin mentioned, we were all expecting a very light budget because there is 6 months down the line we are going to have another budget, but that's not been the case. For indirect taxes, at least we have a budget every 3 to 4 months with the GST Council meeting. So what largely the indirect tax proposals have been in the budget is, implementing what has been proposed in the council meeting, which happened almost a month back, exactly a month back to be precise. And then they have also done certain changes on the customs front to rationalize the customs duty structure, giving impetus to Make in India and, those angles. So maybe I can, Bhavin, should I share my screen? It will be easier for me to run the presentation. Thanks. Is my screen visible? Yeah, thanks.
Yes.
Not able to move ahead. Yeah. So what the GST Council had proposed, most of it was clarified through circulars in the last few weeks. What was pending for being implemented was the law-related changes, and that is what the budget has done. They have made changes to the GST regulation. The first part is for the historic period from 1718 to 2021, there were a lot of instances where credit was being not available to the assessors because of the delay in availment of this credit. What they have done is they've tried to rectify this, and they've said that for the period from 1718 to 2021, the time limit to avail the credit is extended up till 30th of November 2021 if the return if it has been availed in the returns which have been filed up till 30th of November 2021. There have been circumstances when GST registrations have been cancelled or revoked for certain requirements under the law, but later it has been restored. What the amendment says is that if you have availed the credit in the return pursuant to the restoration of the revocation, then you can avail the credit within that 30 days or as per the timeline prescribed in the law. There is no refund if the ITC paid has been reversed already. There was also an issue where, the invoices pertaining or raised on the ISD was not, the assessees were not able to transition that to the GST period because of the technical glitch there. And what the amendment here says is even for the ISD, which invoices which were pertaining to prior to 1st of July 2017 and received after that as well, as far as the transitional credit is concerned, they can be now transitioned to GST. Earlier, the demand notices were bifurcated into Section 73, which was for bona fide cases, and Section 74, which were cases where, there was alleged fraud or malified intention. What now the government has done is they have aligned both the section 73 and 74 into a new section 74A, and that is largely to align the timelines to issue the notices and passing the orders. As far as the penalty provisions are concerned, they are as per section 73 and 74 only. So if there is a bona fide case, there the penalty is a reduced penalty, and if it is a malified intention case, then the penalty is as per the provision which was there earlier also. So effectively from 24-25, section 74A becomes applicable, and prior to section 24-25, the section 73 and 74 were applicable independently. Now, if you would remember, in the earlier regime, as in prior to this section 74A, what was allowed as credit only the tax which was paid under section 73. Where there was a malified intention or a fraud alleged, in those cases, if there was a tax paid pursuant to a demand, that was not allowed as credit to the assessees. Under the new provision, that is section 74A, if you are paying tax pursuant to a demand notice, whether fraud or otherwise, you are allowed to claim the credit. And also they have amended the provisions to include the credit paid in situations of detention or seizure of goods, which was not allowed earlier. The amendment for restriction of claim of input tax credit or IGST, sorry, my bad, on zero rated supply of goods will not be allowed if there is an export duty already leviable on this supply of goods. The pre-deposit quantum, which was proposed in the GST Council, has now been included in the law, and that has been reduced for earlier 2.5 crores independently for CGST and SGST to 2 crores in CGST and SGST. And as far as the tribunal is concerned, the pre-deposit amount is reduced, the threshold or the limit is reduced from 500 million CGST and SGST independently to 200 million CGST and SGST respectively. The pre-deposit ceiling for IGST is at INR 400 million in case of the tribunal. The time limit for filing appeals or applications to the GST tribunal has been suggested to be 3 months commencing from the date of communication of the order, or as may be notified by the government, because there has to be a proper tribunal in place to start filing appeals. So whichever of the two is later, you will be allowed to file the applications and appeals before the tribunal. The tribunal may also condone the delay up till 3 months as far as the GST authorities are concerned when they are required to file an appeal before the tribunal. Now, the anti-profiteering investigations were very rampant in the time when GST got implemented, but now the government is trying to put that to a closure, and they are empowered. They are empowered to now give a timeline up till which the anti-profiteering applications can be filed, and also they have also made a provision that the principal bench of the GST tribunal will be conducting examination and adjudication of the anti-profiteering cases until there is a sunset clause to that. As a relief to the assessees, there has been an amnesty scheme which was proposed in the GST Council meeting, and it addresses a period of around 1718 to 1920, but it is only for a situation where notices were issued under section 73, which was bona fide cases, or where it was issued under section 74 but was eventually held by the appellate authorities to be under that it was not a fraudulent case and it has to be treated like a bona fide case. Now, what kind of cases can be covered under the amnesty scheme is which belong to the period, assessment period 1718 and up till 1920, where notices have been issued under section 73 or the exception which we just discussed, where SCNs are pending for adjudication where no order is passed by either the first appellate tribunal or the first appellate authority or the tribunal, and cases like we mentioned which were originally treated as under section 74 but eventually held to be a bona fide case. There is going to be a conditional waiver of interest and penalty granted under this amnesty scheme, provided the tax is paid within the due date, which will be notified by the government. But the GST Council has recommended 31st of March 2025, but it has to get notified yet. And additional to that, if there is an additional demand which comes after making the payment under the scheme, that also has to be paid within 3 months. So these are the two timelines which one has to adhere to get the benefit of waiver of interest and penalties. There will be no exceptions here. So if you have already deposited tax, interest and penalty, no refund can be granted. And if there has been erroneous refund sanctioned to you by the government, you cannot go for amnesty scheme if there is a litigation going around that to seek waiver of the interest and penalties. There is also one more requirement apart from payment of tax, that whatever appeals and writ petitions are pending are withdrawn before the due date of payment, and the proceedings under the scheme cannot be appealed under. So once you have an order under the amnesty, that cannot be appealed before any authorities, which is very similar to the earlier amnesty schemes as well. Now, Section 74 has revamped completely the Section 73, which was for bona fide cases, and Section 74, which was for cases where there was fraudulent intent or a malified intent or a suppression of fact. What has now, what are the changes? 73 and 74 would be applicable until 2024, 31st of March, for the period until 31st of March 2024. And post that, Section 74A will become applicable for all kind of notices and related penalties. There is a threshold prescribed that if a matter pertains to more than 1,000 rupees, then only it can be under this, will fall within the ambit of this section. Otherwise it will not. There was no such threshold under Section 73 and 74 earlier. The time limit for issue of show cause notice is 42 months from the due date of filing your GST annual return, which was 33 months under Section 73 and 54 months under Section 74 earlier. There is also a time limit prescribed under Section 74A to issue an order, which is 12 months from the date of issue of notice, and with a further extension of 6 months for all cases, irrespective of whether it's a bona fide case or a case which is other than bona fide. As far as penalty provisions are concerned, in case of a bona fide matter, it is 10% of tax due or INR 10 lakhs, whichever is higher. And in case of other matters like fraud, suppression of fact, it is 100% of tax due, right? Which is akin to what was there under Section 73 and 74. Penalty if tax is paid before the show cause notice will be 15% in case of malified or suppression of fact, but it will be 0% if it is a normal case, which is a bona fide case. Also, if the tax is paid within 60 days of issue of notice, it will be 25% in cases other than bona fide cases, and it's not applicable in case of bona fide cases. And in situations where there is a penalty demand and an order is issued, then if the tax, interest and penalty is paid within 60 days of the issue of order, the penalty amount gets reduced to 50% in cases where there is a malified intention or suppression of fact. So this is as far as the Section 74A is concerned. This was largely to align the time period to serve notices and to pass orders, whether there was a bona fide case or otherwise. But the penalty provisions are similar to those prescribed under Section 73 and 74. So going forward from FY 24 to 25 onwards, Section 73 and Section 74 are inoperative, and all the notices will be under Section 74A only. There are certain miscellaneous changes which have also been proposed, which is akin to, or which was also, recommendation of the GST Council. So, extra neutral alcohol, undenatured, and rectified spirit used for manufacture of alcoholic liquor for human consumption, no GST is going to be applicable on it. Second is wherever there is going to be a non-levy or short levy of tax, there the government is empowered to regularize it. There are certain activities which have been now included to mean neither supply of goods or services, largely for the insurance sector. So where there is an apportionment of co-insurance premium by the lead insurer, where there is a joint service of insurance provided by the lead insurer and the co-insurer, there will be no GST. It is not a supply of service or goods, provided that the main insurer pays GST on the entire premium paid by the person insured. There's also a second clarification here, which is where there are services by the insurer and the reinsurer, where the reinsurance commission is being paid to the reinsurer, and it is deducted from the payment made by the main insurer to the reinsurer. In that situation, there will be no GST, subject to the fact that the reinsurer is paying GST on the gross amount, including the commission portion, and not the net received by him or her. Procurements from unregistered suppliers attract GST under RCM, and it is the time of supply is now linked to the date of self-invoice, and the time to issue the self-invoice is also going to be prescribed or notified by the government. Earlier, if there was a summon which was issued to a particular person, that person was mandatorily required to attend those summons. Now, an authorized representative can do it on behalf of the person summoned. Effective 1st of October 2023, an e-commerce player, if they were allowing person exempt to trade from their platform, there were penal consequences. Now it has been specified to include e-commerce operator who are required to deduct TCS, and not all kind of e-commerce players. There is mandatory TDS filing requirement even if there is no TDS deduction, and the timeline to file this TDS returns is prescribed. And there are also certain provisions which make reference to the penalty provisions in the GST law overall, where consequential changes have been made to include section 74A instead of 73 or 74, as the case may be. Apart from GST, there are certain changes prescribed under the customs legislation only. The most critical is every time when you import under a free trade agreement, most of the trade agreements required you to prove that the rules of origin are followed, and there is a certificate of origin which the customs authorities of the exporting country have to give. Now what they have said is, now instead of the certificate of origin, there has to be a certificate of declaration, which is self certification that the goods are imported have been they fall within the requirements of the rules of origin. The government is now also empowered to specify the manufacturing processes and other operations in relation to a particular class of goods in a warehouse to be not permissible. There are also the government is empowered to prescribe procedures for import and export other than which are already there. There are also certain important changes. There is extension of timeline in case of re-import of aircraft and vessels which are imported for maintenance, repairs and overhauling, which was earlier 6 months, and now they have been extended to, that period is extended to 1 year, and a further 1 year to subject to approvals. There was a time limit to re-import duty-free goods other than which were covered under the export promotion scheme. Earlier, the time limit was 3 years. Now it has been increased to 5 years. There are certain rate changes to rationalize the import duties. First is there has been an increase in the customs duty rate for certain products like laboratory chemicals, PVC films, and in certain cases, the effective rate, however, remains the same. There are certain new tariff entry lines which have been introduced to align to the evolving market or the manufacturing, which is e-bicycles, textile products used in Indian semiconductor machines, and so on and so forth. There were certain exemptions for goods like lithium-ion cell, portable X-ray machines, raw materials used in the manufacture of semiconductor devices. Their exemption timeline has been increased to 31st of March 2026. There have been notifications under customs which have exempted certain drugs, raw materials used in the manufacturing of certain electronic goods, and capital goods used in the technology and electronic sectors. Those goods, there was an earlier notification I think in 1999, which have been extending over the period of time, and now it has been up till the last amendment. It was available till 30th of September 2024. Now, with the current amendment, it has been extended till 31st of March 2029. Apart from that, there are certain exemptions which are lapsing, like batteries for electrically operated vehicles and inputs for manufacture of syringes, needles, so on and so forth. There are certain exemptions which have been extended perpetually, forever, like materials for educational or vocational training, and certain wall pictures and diagrams for instructions. There are important changes. Of course, what I'm discussing is only sample or indicative. There's an increase in BCD for PCBA of specified telecom equipment. There has also been a reduction in the duty rate for critical minerals like beryllium, bismuth, and so on and so forth, ferronickel, also certain cellular mobile phones, PCBA for cellular mobile phones, and gold bars and platinum, silver bars, and so on and so forth. There is also AIDC, Agricultural Infrastructure and Development Cess reduction on gold bars, platinum, silver bar, coins of precious metals. So effective duty rate for precious metals like silver, platinum, gold has come down. There's also export duty on certain products which are exported out of India. That rates have also been reduced on leather and similar items. Apart from that, there are minor changes in the excise duty. Earlier, in mega power plants, a bank guarantee was provided for claiming for the exemption claimed from excise duty for a period of 126 months, which has now been extended to 162 months. And there was a clean energy cess which was applicable on coal. Now there's an exemption granted on it for the stock of coal as on 30th of June 2017, that is, which was there at the time of implementation of GST, provided the dealer or the assessee pays GST compensation cess on such coal at the time of clearance of the coal, which was in stock on 30th of June 2017. So yeah, that's it from IDT. Bhavin and myself have tried to take you through the major changes on a tax front. But yeah, we are free to take any questions that you may have. And as Ricky mentioned, please put them on chat and we'll be happy to answer.
Thank you, Ms. Payal and Mr. Bhavin. I think very detailed, I think, a presentation by both of you. I think I thought that I had read the budget proposals in some detail, but I think today your presentation made it clear that I probably read only 10%. Yeah, so I think thank you for that. Maybe I can start off, and I think Ricky requests the participants to put their queries on the chat box. So Mr. Bhavin, maybe if I can request you to probably what would be the rationale behind this move on this buyback provisions? I think earlier to this they were actually treating both buyback and dividend on par, and I think really the corporates didn't have much to choose between the two. But why would they have come back on the buyback in such a fashion? Any rationale to this in your thinking?
So, sir, there could be multiple reasons. One is, of course, we are already having a tax dispute with one of the company, and the quantum is fairly significant with whether capital reduction would result into a buyback, or whether it is a taxable or not taxable event. So, just to put an end to this issue, perhaps they would have said that, okay, if we were to treat everything as a dividend itself, then there is no dispute whether it's a capital reduction, whether it's a dividend, it's going to be taxed at a same rate. So that could be one particular area which could have been there. But interestingly, if you look at the dividend, other aspects of the dividend, so dividend has 4 different or 5 different aspects, and 4 out of the 5 would be taxed only if you have an accumulated profit. So if a company under a liquidation distributes an asset, if there is a capital reduction and the assets gets distributed, now all of those things will be taxed only and only if there is a accumulated profits lying with the company. Now, here is a situation where entire amount is being brought to tax. Of course, I mean, the question of, I would say, accumulated profit should not arise, because unless a company is not profitable, the question of declaring dividend itself is a big challenge from a company law perspective. But having said so, this is one area. The second area is, treating a capital loss differently. So whatever my cost of acquisition is, if that is to be treated as a capital loss, and the dividend I have to pay tax straight away 30% on this. Now, this is where a challenge arises for the taxpayer. Had it been allowed to set off, had it been allowed to net it off, then things would not be as problematic. In fact, the law further says, or the proposal further says, that you are not allowed to claim any deduction with respect to this dividend. So again, a problem statement. But to answer your question, probably to do away with the dispute that is arising, where the taxpayers try to classify this as a capital reduction vis-a-vis a dividend, vis-a-vis a buyback.
Okay. I of course would love to ask you some more, but let's see whether there is anything on the chat box. We get to this thing. I think something on a query on IDT. Okay, well, I think that seems more like a number issue. Okay. And I think also, Mr. Bhavin, I think on this Vivad Se Vishwas scheme, now that it's coming back again, and now it appears to be coming back in a reasonable regular frequency. Again, what would be the rationale for government to, earlier days, I think it was said that this would be, once in a while. It may not have, you should not be, you may not get to exercise it often, and that used to be the push to the assessees. But now this seems to be like coming back every 2-3 years. Is that how the corporates, and meaning all the assessees, should start looking at it? That there will be schemes that will come every now and then?
Certainly not. You should not do the planning with respect to the fact that sooner or later there will be one more amnesty or Vivad Vishwas scheme going to be there. But see, the agenda is very clear to reduce the litigation. Now, the number of cases which gets piled up either at a CIT level or at the tribunal or at a higher forum, it adds to the litigation, and it adds to the litigation cost both for the taxpayer as well as for the revenue authorities. So this is one particular scheme where they would want to reduce the number of cases that has been piled up as on date. If you look at the last VSV, what I could gather from the information available in public domain is there are about 99,000 crores of tax dispute which got settled in the last VSV scheme. So if you want to achieve that number or a number higher than that, then there has to be more sweeteners, more enablers in this particular scheme itself, such that you will find more takers from the taxpayer standpoint.
All right. Okay. And do you see that the provisions of this new scheme are fairly akin to the earlier ones, or there are some benefits more or less?
I would not say there are more benefit. It's almost identical, I would say. Of course, we will have to wait for the computational mechanism and some other aspects. But what interestingly, we already have BSV 2020, and post that there have been disputes which has gone to High Court, where we have seen High Court giving those dispute in favor of the taxpayer. So it is interesting, and just to facilitate government so that there are more takers, that all those issues are adequately addressed in this particular scheme itself. So unless those issues are not going to be addressed, you will not find more takers.
I see one query on the chat box. Indexation removed only on removable capital assets or also on equity?
It's on all. No indexation henceforth.
Understood. Okay. And I think maybe Ms. Payal, I think on this minerals, I think there have been lots of customs duty and benefits being given with a view on renewable sector part of it. Now, is this a substantial impact for this particular sector in your view, or are these some nominal amendments that's come through?
So this is, I think, mostly done because they are trying to streamline the way the import duties are applicable, because they're also trying to see that there is no cash blockage, or there is no credit blockage for the industry. So in terms of liquidating, the timeline to liquidate this credit is significant, and I think that is the reason why they have brought this amendment to align the entire credit process for the industry.
Sure. Okay. So, Bhavin, are you also expecting any pushback on this large indexation benefit going away, and any, there has been, in my internal discussions, there have been people telling that 2001 or the 2000, I think the capital property valuation base that was set, something like that may need to be brought in currently as well, to compensate for this large change that has come in. Otherwise, the capital gain tax will be very, very large for assessees. Do you expect any changes coming, any pushback expected on this one?
So yes, you are bang on to say that any old property, let's say a property which has been acquired 10 years back or 20 years back, the capital gains, if you were to remove the indexation benefit, is going to be huge. Despite the fact that from 20% we are going back to 12.5%, but not giving an indexation benefit for a property. Let's say in 2001, if you have acquired the property, you get a step up of cost through this indexation up to 3.63 times. So this is going to eat up a lot of your capital gains tax. Rather, it will have a lot of capital gains tax impact because of this removal of this indexation part of it. At least on the immovable property, maybe the government should reconsider to say that, look, on the immovable property or certain class of assets also, we would want to retain indexation. And it's only when it comes to a pure shares or maybe a listed shares itself where they may want to do away with the indexation side of it. So yes, it should be there.
Sure. I think this is the one that I think at least every SSC has woken up to, that that could be a large impact coming out of the proposal. Also on the personal tax side, it appears that the government is going and pushing everyone towards a new tax regime over a period of time, and I think the tax benefits that has been brought in, 17,500 that's been talked about. Then I think this NPS movement changed from 10 to 14% all around the new tax regime side. So it appears to be more that anyone opting for the old tax regime will slowly be in a disadvantageous position. Your reading or anything on this?
Yeah, absolutely. It's more of a push to say that you need to go to the new regime. In fact, if you see last budget itself, they have made the change that unless you decide to go for old regime, by default, you will be going into new regime itself. So today, if a person has to file the return, opting for the old regime, then he has to specifically file a particular form basis which only then that person will be allowed to participate in the old regime. Otherwise, by default, you are shifted to new regime itself. So yes, there is a push from the government, and what I see is slowly and steadily all the deductions, all the exemption sections will go away, and we will be having the simplified regime itself where there are least number of exemptions and deductions. I think that's where we are heading towards. So I would not be surprised in the new direct tax code or the new act or the simplified act, we will have only one regime with least number of exemptions or deductions.
Well, you are certainly predicting an early death of the old tax regime. Okay. I think there's some questions again. I think on the property alone, on the indexation thing again, I can see that old properties held before 2001 would still continue to get indexation benefits. Is this clarified by FM?
So for the old property which have been acquired prior to 2001, you already have the benefit to substitute the value by getting a valuation report as of on April of 2001 itself. So to that extent, you in a way are getting compensated from the indexation perspective because you are going to step up the value itself. So that will be grandfathered. But there onwards, if you are asking for an indexation as on the law which has been provided today or other which has been proposed today, you will not get any further indexation benefit from 2001 onwards.
Okay. And grandfathering for capital gains on property for indexation is applicable or not? Please confirm.
As I said, the only grandfathering is up to with respect to this 2001. So anything that you sell even today, I mean anything that you sell even yesterday also, all will be brought to tax without indexation.
Got it. All right. Okay. So I think I think those are the set of things that I think are of this thing, but a lot of minute tax proposals, for us to read and understand over a period of time. But I'm very happy that I think from video side, I think you've done a very fantastic job in bringing them all out in a matter of hours and putting them out in a presentation the next day morning. Thank you for that. I can see one query come in. Okay, is CIA planning to send some recommendations to government on budget proposals? Yes, I think this would be taken up as part of the CIA forum to give some feedback and this thing. I think that would be logical to do as well. All right. So, Ricky, do you see any more questions coming in? Should we end the session?
One more 80 CCD deduction of 14% for new tax regime. But what if the employee opts for the old tax regime while filing ITR?
No, so this new national pension scheme related 14% deduction and even the contribution side of it, it's applicable only for new regime. So if you are in the old regime, this will not be applicable. So you need to switch to the new regime.
This
I think that's it.
Sorry, yeah, okay, sure. So sorry, maybe last, Bhavin, I think this angel tax, this thing has coming out of the lots of litigations that the government ended up facing, or is it more like an,
See, it was more of an anti-abuse provision where the government was not so sure in terms of the who actually the investor is, and whether the premium and the face value or the price at which they are putting the money inside is that genuine or correctly determined or not. So those were the concern. But if you look at the company law itself, now you have dematerialization even for the unlisted shares itself, right? So at least you will come to know who is the investor. You already have section 68 where you say that the company has to, while issuing the shares, needs to know the source of the fund of the investors and source of source also. So there are enough mechanism already there in the act as well as under the other laws, basis which you can catch who is the investor. You can catch what investment has he or she has made. So maybe those provisions should be able to address the concern as far as the tax authorities or the government is there. in terms of the litigations that we already have in hand, because this provision is being made applicable prospectively. So that's where the issue would arise, that, how the government would like to see this. Would they want to put this as a part of VSP? Would they want to treat this differently so that, the litigation amount on this particular issue reduces quickly? So that's the new challenge which we would now need to deal with or grapple with, because the law has been abolished as we speak. So perhaps there is no much meat left in terms of litigating this further.
Got it. And I think we have one query comment, which is standard deduction of 75,000 applicable to new tax regime or old tax regime as well. I think this was
everything is for new regime. There is nothing
That's
for
right.
the old regime.
That's right. Right. Good. So, all right. Thank you. I think Mr. Naveen, I think Mr. Bhavin and Ms. Payal, I think quite a wonderful presentation. And, I think we've been clarified of so many proposals which have been in details. Thank you for that. And thanks CII, Ricky, for organizing. And I hope everyone participating had a good understanding of the budget. Thank you all.
Thank you.
Thank you.
Thank you so much.
Thank you.